Economics 101, the Philly Fed Manufacturing Index. This month's report in particular reveals several challenges that the manufacturing industry has really been plagued by. The Philly Fed Manufacturing Index is a monthly survey. It's conducted by the Federal Reserve Bank of Philadelphia. It shows us the manufacturing conditions in the Third Reserve District, including Eastern Pennsylvania, Southern New Jersey, and Delaware. Now, the Philly Fed's manufacturing gauge slumped to a 20-month low. We can see here the Philly Fed, this is a general activity, now registering a negative 16.4. This is the lowest low we've seen going back to early 2023. Certainly not good. We spoke earlier this week about the Empire State Manufacturing Index. This is significantly worse. Now, the Philly Fed Manufacturing Index is broken down into several sub-reports. There are a number of different themes that this really does reveal. Shipments down negative 1.9, new orders down 4.3, but at the same period of time, delivery time positive 11.6. That is also not a positive turn of events. Now, the biggest news by far is the prices paid, prices received. If this sounds familiar, we spoke about the same thing in the Empire State Manufacturing Index. And what we're going to show you in just a moment, by the way, this is not only contained within manufacturing. This is an issue that is across our entire economy. But prices paid, that reflects the prices manufacturers have to pay for raw materials to produce those goods. Prices received is what the manufacturers receive from the consumer. Notice the divergence. Prices paid significantly higher. Now, when they pay more and they're able to charge less, well, that's profit margins that are squeezed. Here are the different sectors within the Philly Fed. In particular, notice the blue line at the top, prices paid. That's the highest line we have here. That's the strongest component, the strongest, meaning not in a good way. And unfilled orders, that's the red line. That is also experiencing a very fast rise. And that is also not good. Now, we're not exactly sure why the unfilled orders in particular is rising so quickly. There have been strikes. Maybe there's logistical reasons, but nevertheless, this is not a good turn of events. Now, this is really interesting. We know the prices paid minus prices received. That's the yellow line. That's rising over the past couple months. That's the result, again, of the manufacturers have to pay more for the raw materials and they're not able to pass on the additional costs to the consumer. The consumer can't afford it. But the blue bars here show us PPI minus CPI, producer price index on a year-over-year basis minus consumer price index. This is not only contained to manufacturing. This is economy-wide. And what we're showing here, economy-wide, is that the inflation that we're really seeing, the strongest part of the inflation, is at the producer level. Now, it's thought that the producer will eventually pass on those extra costs to the consumer. Now, earlier this month, notice March through June of this year, we saw a decline in the blue bar. That means PPI minus CPI declined. Producer prices, relatively speaking, were a little bit less. That's good news for the manufacturer. And notice there's a loose correlation. Prices paid minus prices received also declined. Unfortunately, that's changed though. In the past couple months, we've seen a spike back to the upside. The prices paid has increased, relatively speaking, to the prices received. Does this mean manufactured goods will rise? Perhaps. We don't yet know the results of our December PPI and CPI. We won't until next month. But it'll be very interesting to see if that also follows suit, if the PPI rises more than the CPI. If that does, that's not good news because, the Federal Reserve just met. They cut interest rates, but they're expected to cut rates a lot less than they were before, primarily because inflation is not going away. It's treading water. And that if we see a rise in PPI versus CPI, that could lead us all up, the inflation chain once again. That would not be a good turn of events. It'll certainly be very interesting to see if this carries over. As a reminder, this is part of our series, Economics 101, where we do our best to cover the most significant economic numbers and try to demonstrate their relevance to the overall economy. We hope this has been helpful. We look forward to seeing you back soon.